Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer for just $99 a month, where you get everything in our web tools as well as commission-free trading. So without further ado, we're starting off today using a tighter resolution to try to address some of the feedback we've gotten about it being a little difficult to see some of the small text. So you'll notice that the screen looks a lot larger today. The the main thing we're going to look at in the portfolio is just that it continues to move. It's actually been a bit of a not really a negative day for us, but Carnival, we kind of rolled a bullish trade yesterday. Microsoft, we rolled a bullish trade. Those have gone against us a little bit. Not a huge deal. Nvidia has actually, they surged up earlier. They were around 155, which was great. But right now, the bottom line is they're above our strike. They're above our short strike. So if we can hold off through Friday, we should be able to collect the full credit for that trade. Overall, a pretty good day. Considering that we are a little heavier on the beta weighted delta. Since we are kind of a little heavy at this point, we will expect that on down days that we should see a little bit of decline in the overall portfolio. But there's going to be profit taking. Not really concerned about the overall market just yet. But the main thing I wanted to talk about today was not adding positions, although we are going to keep an eye on the market and see if we need to put in something bearish to help protect us a little bit for the downside that might come in the coming weeks. I wanted to look at putting on another earnings trade. And I kind of went over to our screen, grabbed this a save screen that we had. If you recall, this is just up to 1 day for trading days until earnings, which means that today's the last day to trade the stock before it announces. And then we want at least good options and, of course, weekly options. And I'm looking for a way to set up a calendar straddle trade. And the trade that jumps right to the top is actually the trade I was looking at earlier, which is GoPro. There's some interesting thing going on with the options data right now around GoPro, the numbers. And you'll notice, first of all, their daily trade, they're just hanging tight. I mean, they are just sitting here in this pennies range for the past couple hours. And I don't expect that they'll probably move too much. As you'd expect to see this nice decline, this huge slope we get for this week's earnings at 261, which is really high. Next week's is 151. And even the long-term IV right now is being impacted. Even if we go all the way out to the 2021 options, it's still in the 56 range, which is a little bit high for even a stock this volatile, or for the potential to be as volatile as this one. The big number here, though, is this 4,000 basis points that the earnings richness is overpriced by at this stage. And it's not just that it's overpriced, it's more that this long-term volatility mean is probably overpriced as it is right now by a good third. It's probably going to be closer to 50, maybe a little below once all the dust settles from earnings. But this could produce a good opportunity for buying, because the combination of there being an earnings crush at this, under 50%, and then of the richness being over 4,000 basis points, we should be able to set up a very, very attractive calendar straddle or a calendar strangle. In this case, because we're dealing with a stock that's priced so low, I'm inclined to go ahead with probably the straddle at this stage, because the strangle sort of expects a bunch of movement. I don't really know, honestly, what to expect. If we go for a neutral view on the stock, what you'll see is we can see that the plus or minus one volatility movement at this implied volatility puts us at $4.0650. That's really a function of the pricing. And you'll also notice we've got a ton of puts that are held in open interest. The dark bar here is volume. The lighter bar is open interest that was held as of market close yesterday. And the same thing on the other side. So these light greens are the calls that are held in open interest, and the dark green is the relative volume. And this is just kind of a view to see over the chain, like how can we visualize along with these skews up top. So I feel like what we're looking at is a pretty not surprisingly, a pretty polarized set of expectations here. People are generally avoiding the calls that are in the money and the puts that are in the money. So I think we're going to see some good movement. But the question is how much and what do we need to do in order to capitalize on it if we don't really care which direction it moves in. So in this case, a couple other things is the put call ratios here. There's not a lot we really can read into them at this point. Except, if we look at the fact that there's a lot more puts that are held by volume today, and yet we had slightly below what would be considered the average. Well, actually, it's right in the middle of the zero point 0.6 to zero point 0.8 range for the open interest for the put call ratio. This is the volume of puts divided by the volume of calls traded today for this expiration. So generally, when it gets up a bit, this would mean that people are trading puts more than they're trading calls, and it doesn't tell us what side people are on. And you can't really infer it from the implied volatility because of the fact that the volatility is going to rise into earnings. So under ordinary circumstances, when the volatility is increasing and the put call ratio is increasing, that would tend to hint that people are buying puts. But in this case, we're not going to use this data here because it gets thrown off by the earnings. It is good to know, like, the forward price is right at the current money, so that means that there isn't heavy bias towards puts right now. Like, the stock's not hard to borrow as it was, back when it was in the 100 range about a year and a half ago. The put break even, meaning that if you have a put today, the average put that's held in open interest would break even at $4.23 if you open that transaction today at its current pricing, and the call break even is about $6. So this is another alternative to implied move, is to say from 517 we're looking at about what might be an 80-cent drop or so based on that, and about an 80-cent rise based on that. So we say plus or minus 80 cents from this $5 range. I think what we'll probably do, and I kind of looked ahead here, is I'm going to go to the option chain for GoPro for this week, and I'm going to take a look at the $5 ones, which is the closest we can get to the money, and we're going to take a short straddle. And when we look at the short straddle, let me hide this guy. The short straddle is, obviously it's naked. We're not going to open a naked trade here, but this is going to be the first half of our calendar straddle trade. We're going to look to sell this. So from the model and book, I'm going to add it to my account book to look at, and it should be the only thing in here right now. Good. And then I'm going to go back to look at that trade I was just looking at. I'm going to jump forward by 1 week to find those options, and now I'm looking at a short straddle for the following week, but I'm going to invert it to get myself a long straddle. And these are going to be basically the hedge, or depending on which way you look at it, this is the trade you might want for the longer run. And when I choose to model that in the book, it's going to combine those two positions, or those two trades, and give me a P&L like this. Now, the thing I'm going to tell you off the bat is this is a misleading P&L diagram, because right now we talked about, we're trying to capitalize on the fact that volatility is really, really high. And what we want to do is we want to make more on the drop in the short-term volatility of this week than we lose on the long-term volatility for next week. And obviously next week's not that long-term. But the thing that's most interesting about this is we're just looking at quantities of one, right? And we have it hedged off. So if we sort by the bid, we should get these closer. So this long call for next week and this short call for this week, almost they cancel each other out for delta, and the same for the puts on the other side. But here's what's really interesting. Because the pricing for the bid-ask spreads are so tight, right? The fair price for this, you'd say, is 59 cents. This one, you'd say 56.5 cents. Would you pay 2.5 cents for the change in the value of this call option struck at 5 after this week? Because we can assume that up until expiration on Friday, these guys will be lockstep in price. There will be virtually no difference in how much they gain, except that the next week option is going to retain a little more value. So what we're kind of looking at here is a position where we're saying we want next week's straddle. Let's say we want the straddle for the 15th, that's at the money today, and we're going to finance it by selling this week's straddle, which is at the money. And the net of it is, what they're telling us here, is that if we opened it with market pricing, we would pay 7 cents a share for that. Now, of course, that means that all the gains between now and end of day Friday would effectively be canceled out. But then if we feel that the stock would continue moving in that direction through next week, or possibly move more, then there'd be a lot to gain. We do run the risk, though, of the stock running up, let's say, through the end of this week, us having to close out the short position, pay a ton to close it out, and then have the our call for next week. If the stock kind of falls back a little bit, we end up not making as much money on our long call as we had to pay to close the short call. So that's our risk case here. As a result, for this particular trading setup, what I would advise is With this 7 cents we're looking at here, what we'll try to do is just say, we're trading commission free here. So we're not worried about the pennies that we have to worry about when you have like a dollar per contract. Because rolling back for a second here, if we were going to do just this spread, we were going to buy this call and we were going to sell this call, and we bought it at, let's say, we just paid the market price. So we paid 60 cents for the long one and we sold the short one for 56 cents. That would mean it's 4 cents for us to open the position. But we're also paying $1 a contract here, which is about 1 cent, and we'd be paying $1 a contract here, which is another cent. So we're really paying 6 cents for what would be 4 cents in a commission-free structure. Plus, we can scale this up commission-free as much as we want. So the other thing I want to show you is that when we click through, that's the market pricing. In this case, it slid out to 8. It's now at 5. I saw it at 4 a little earlier today for the midpoint. Now, midpoint's going to be tough to get because, again, with market makers, we're going to have to get one person or one entity out there that's going to fill the entire trade for us. So it might be a little bit difficult to get that to happen. So what I'm sort of expecting here would be we'll probably want to leg into this off the air. But the goal is if we end up somewhere between 7 and 10 cents, then the question is, when we get into the market tomorrow, do we think that our net long position will be worth at least 10 cents per share more than our net short position? And in this particular case, I think it would be. I mean, it's it is a low, it's a low stock, but the other side of the thing that this is sort of the devil case here about why we might not want to enter this trade is to say this looks fine here if we're looking at a stock that's trading at $5 a share, and we say, oh, all we have to do is, like, right now if we bought it and we got it for 8 cents, well, if we could sell it for 10 cents tomorrow, right, that would be a 25% gain on the trade, which would be great. We'd be really happy with that. But the downside to think about it is that those extra 2 cents here, if this was a $50 stock, that'd be 20 extra cents, and just scaling it up by 10. Now that isn't as easy. It's not as easily said as it is done, or it's easier said than done is probably what I mean to say. And the reason I get into that is because when we want to close this trade out, we are going to have to account for liquidity on the other side. So even though we can get this, we should assume that we might lose a few cents in trying to get out of the trade. And I'll tell you from the experience we had over the past few weeks of exiting these trades, it's been tough in some cases. Now the good news is GoPro generally has at least fair liquidity. So the spreads will get a little wider. Right now they're almost about as tight as you can get, but they are pretty manageable. Now at this stage, I think we'll probably go ahead with this. Now if we went through with a lot, let's say we bought 100 of each or sold 100 of each of these guys, right? We're still looking at that 6 cents. If we previewed it, preview at 5, it would be a $500 trade. Now, the way we would lose all of the value in this trade would be one of two ways. One is if we close out our short trades, our short positions, and we hold the long positions, and we don't end up exiting the long positions for more than we entered in here, relative to the amount of money we gave up in the short legs. That is, of course, that's just a trade management thing. It's risk you take after you're in the position. The plan we would have here would be to basically open this up now and then close it out tomorrow as soon as we see the big vol drop. And then hopefully, now this is the other part of the trade that I'm going to back into the book for a second. This is the other part of the trade that's tough. We don't want this to move. So if this ends up right at the nose on, at $5, then effectively what happens at that point is these the short-term call and put, they approach zero, which is really great. I mean, they'll still have a bunch of time value because they're at the money until expiration, but they approach zero, and these will retain a lot more time value because it'll be way juicier to own those for next week than it would be otherwise. So that's sort of the goal we have here. But based on the fact that the volatility is where it is, that's not really the expectation. The expectation is that we're going to see big moves up or down. So in the event that we have a big move, the other problem comes into play is that this the difference between the pricing on, let's say, our calls, let's say we have a move up and it goes up to $6. Now at $6, our $5 options are, at that point, they are like 20% of the money. Not exactly, but let's just say 20% of the money. So that's kind of tough for us because, like, how much extra, like, at that point the deltas are basically 1. So there isn't really room for a lot of extra time value that's going to come in, because you're going to have to pay the intrinsic value plus a premium, most likely to, I mean, of course, to close this out. And then, like an issue, for example, we had last week when trading Semantic was, even though we had calls that were, pretty deep in the money, we had to sell them for slightly less than the intrinsic value just to get the fills, because the spreads were so wide. They just didn't have the option liquidity. So at this point, I'm kind of talking myself a little bit talking myself out of the trade. I do feel pretty confident that there is potential to make this trade work. But I don't want to I don't think we're going to go for a full lot behind it. I think what we'll do is we'll probably go in for, before when we saw 100, we were trading at 100 of these would have given us a $500 cost. I think what we'll do is we'll try to hit a single here. We'll just, if we go in for 20 and let's say the net debit's at 7, we can get in for the trade $140. This is a bit of a, it's a little bit of a gamble. I don't like taking the gambles, but I also think that the pricing here is something that could be advantageous for us. So I'm going to put it in at 6 cents, just to see if we can get anybody to give a take for it. $120 even better. And we'll just kind of let it sit there. There is part of me that thinks that we might want to take a trade like this and see if we can open it where maybe what we do is we enter the trade. If it goes up, which I expect it to do after hours, just based on the things that I've read, it sounds like GoPro doesn't really have anywhere else to go but up at this point. But if they, if the puts end up sort of, we close that out in the morning. If it goes up, because these puts are going to be worthless. These struck on the 8th, they're going to be worth 0 if it goes up to 6, let's say. These puts for next week will probably be worth maybe a few cents, in which case we can hopefully make back what we paid to enter the position. But again, that might be tough. Or, and this is always another possibility, we hold these puts. If it rolls up to 6, I mean, if it moves up to 6, we just roll these up to 6 as well, and we enter ourselves into a bit of a spread where we can make up the credit for the difference in the loss for the trade. So I'm thinking that's what we might do. I'm going to handle this off the air. I know it's not super exciting to watch, but in the event that in the event that we do enter this trade, if we can get the right pricing for it, we will review it tomorrow, hopefully with some profit to talk about. But in the meantime, I'm going to cut it off there. And if you have any questions, please leave a comment in the leave a comment below, or hit us up at hello@quantcha.com. And as always, good luck and good hunting.